Hello, everyone. Welcome to the sixth class of our course on the Introduction to Financial Markets. Today, we will delve into a crucial topic for understanding markets: macroeconomics. We will explain what it is, its objectives, the important variables, and how economic cycles impact the economy and our investments. Additionally, we will analyze the characteristics of economic cycles and mention some tools that help us better understand these processes. So, let's get started. Disclaimer: the content of this channel is for educational and informational purposes only. It should not be considered financial advice, investment recommendations, or an invitation to engage in trading in financial markets. Always conduct your own research and consult with a financial professional before making any investment decisions. Investments carry risks, and we do not guarantee any specific outcomes. If you're ready, let's get started. 1. What is macroeconomics? Macroeconomics focuses on the global analysis of the economy, considering large aggregates such as goods and services produced. GDP measures the total value of goods and services of an economy over a period. Total income related to GDP. Higher production implies higher income. Employment level influences economic stability, as it is directly linked to the purchasing power of the population. Productive resources, such as land, capital, and labor, which determine the growth capacity. Exchange rate affects international trade and investments. Price behavior, inflation, a fundamental aspect to measure economic stability. Macroeconomics helps us understand the global landscape and its impact on financial markets, providing a framework for interpreting economic policies and international events. 2. Objectives of macroeconomics. The main objectives of macroeconomics are economic growth, increasing production capacity and the well-being of the population. Price stability, keeping inflation controlled to protect purchasing power. Employment promotion, maintaining low unemployment rates to ensure social well-being. Balance of payments, achieving a balance between exports, imports, and investment flows. These objectives guide economic policies, directly influencing investment decisions and the behavior of financial markets. 3. Key macroeconomic variables. Growth level, GDP, an indicator of total economic activity. Growth capacity, related to investment in technology, infrastructure, and human capital. Competitiveness, influences a country's ability to attract foreign investment. Economic structure, understanding which sectors dominate the economy helps us anticipate its stability. Exports and imports impact the trade balance and the exchange rate, influencing prices and monetary stability. 4. Economic cycles. Economic cycles are the recurring fluctuations in economic activity, and each cycle is composed of several phases. Depression phase, severe drop in GDP, rising unemployment, and low economic confidence. Expansion phase, recovery of growth, increase in employment, and reactivation of investment. Stagnation or peak phase, maximum growth point, where the economy slows down. Recession phase, GDP contraction for at least 2 consecutive quarters, with rising unemployment and reduced consumption. 5. Characteristics of economic cycles. To better understand cycles, it is essential to know their characteristics. Periodicity. Cycles do not follow a fixed time pattern. An economic series may grow or decline out of sync, making it difficult to predict when a new phase will begin. Amplitude measures the intensity of a cycle, indicating the magnitude of fluctuations, i.e., how high the peak or how deep the trough of the cycle can be. Duration refers to the time span of each cycle. Cycles can be long wave, approximately 50 years. Large cycles, 7 to 11 years. Short cycles, 3 to 4 years. Recurrence indicates that cycles tend to repeat, although irregularly. Shape refers to how the economy's oscillations evolve gradually or abruptly, depending on the severity of a crisis or the speed of a boom. These characteristics help analysts and investors anticipate market movements, understanding that each cycle phase brings different opportunities and risks. 6. Tools for analyzing economic cycles. To analyze economic cycles, several tools are used, including leading indicators. These indicators, such as manufacturing orders or consumer confidence indices, help anticipate changes in economic activity before they occur. Coincident indicators show the current state of the economy, such as GDP or employment rate. Lagging indicators, such as the unemployment rate, which tends to react after the economy has changed phase. Econometric analysis models. Mathematical tools that allow projecting the behavior of economic variables and understanding the relationship between them. Fiscal and monetary policy. Analyzing how government and central bank decisions, such as changes in interest rates or public spending policies, can influence the cycle phases. These tools are fundamental for conducting detailed fundamental analysis, enabling investors to make more informed decisions. Today, we have thoroughly explored macroeconomics, its objectives, key variables, and how economic cycles affect the economy. Understanding these dynamics is crucial for analyzing financial markets and anticipating investment movements. Remember, a solid understanding of macroeconomics helps us navigate better through the opportunities and challenges presented by each phase of the economic cycle. So keep studying and deepening your knowledge in these areas. If you enjoyed this class, give it a like, subscribe to the channel, and activate notifications to not miss the upcoming classes on fundamental analysis and macroeconomics. See you in the next class.